Hi there, I am Suk Day. I'm a chartered accountant and an MBA. In this lecture, I'll be talking about hedge accounting. Now, hedge accounting is an important topic in professional accounting examinations. All publicly traded international companies face market risk, and entities use derivatives to mitigate these market risks that can impact negatively on their financial performance. Now, the use of derivatives to hedge market risk is a complex topic, but a working knowledge is required for professional exams. So we look at the common types of derivative contracts used to hedge market risk. We look at the recognition, measurement, and presentation of derivatives in financial statements. We look at the criteria that must be satisfied to apply hedge accounting. And finally, we look at the different types of hedges simply because they have different accounting requirements. What is a derivative contract? A derivative contract is a contract where two parties agree to trade certain goods, assets or liabilities at a given price on a future date. It is recognized when the entity becomes a party to the contract. Measurement. The derivative's value derives from the difference between the price of that asset or liability fixed in the contract and the spot price at the date when the contract expires. At the date when a derivative contract is set up, its initial value is nil as the price of the underlying asset or liability is fixed on the date of the contract. Subsequently, or even on the settlement date, the value of a derivative contract will change depending on the changes in the price of the underlying asset. And on settlement date, a derivative contract is settled by the net payment or receipt of cash. Derivative contracts are a very effective tool for managing market risk, as a derivative constitutes a bet that something will increase or decrease. Examples of market risk: interest rate risk. Derivative financial contracts to minimize interest rate costs are interest rate caps and interest rate swaps. Swaps essentially means that you're exchanging variable interest payments with fixed interest payments. Foreign currency risk. An entity is exposed to the risk of exchange rate fluctuations on the purchase or sale of products denominated in foreign currencies. Derivative financial contracts such as forward foreign exchange contract fix the exchange rate in advance for payments or receipts to be made in the future. Finally, price risk. The risk that the price of something, it can be a good or a service or an investment, will change significantly such that it will result in a loss to the entity. So the entity enters into a derivative contract again to fix the price that will be settled on a future date. Common types of derivatives contract used by businesses to mitigate market risk. We'll start looking at the first one, which is a future. It's a standardized contract traded on an exchange and a market to market daily. In other words, there is a price for that particular contract every day. The next one is a forward. A customized future contract is called a forward contract, which is settled at maturity. As they are privately traded, they are referred to as OTC, over-the-counter contracts. Options. An option is a particular type of derivative contract that gives the owner the right, without the obligation to trade the underlying asset for a specific price, which we call the strike or the exercise price, at some future dates. A swap is a derivative contract through which two parties exchange the cash flows from two different financial instruments through an intermediary bank. So common one is an interest rate swap, is a forward contract in which one stream of future interest payments, example a fixed rate, is exchanged for another, example floating rate, based on a specified principal amount. The purpose is to reduce or increase exposure to fluctuation in interest rates. Currency swap is also known as cross-currency swap, is a legal contract between two parties to exchange two currencies at a later date but at a predetermined exchange rate, for example euro and pound or euro and dollar. And finally we've got index links swaps. This manage inflation risk. A stream of future fixed interest payments is exchanged for an index linked payment, usually again through an intermediary bank. Hedge accounting, which is dealt with in IFRS 9, deals with the recognition, measurement and presentation of hedging activities in financial statements. All hedging activities require the identification of the hedged item, and this can be an asset, liability or a probable forecast transaction which is exposed to risks of fair value changes or cash flow changes. Finally, the other instrument is the hedging instrument, and this is the derivative contract that the entity has entered to mitigate the market risk, and we discussed that in the earlier slide. You had things like forward contracts, futures, cross-currency swaps, options, and so on. Now, these are derivative contracts that the entity has entered into mitigating the market risk. The rationale underlying hedge accounting is that the changes in the cash flow or fair value of the hedged item and the hedging instrument are expected to offset each other during the hedge period, i.e. the gains or loss on the hedge item is cancelled by a corresponding gain or loss on the derivative contract. When this happens, there is an effective hedge. In hedge accounting, there are two measurement bases. The first one is called fair value through profit and loss. This measurement base applies to derivatives that do not meet the criteria for hedge accounting, or the entity chooses not to make an election to apply hedge accounting. Here, all unrealized gains or losses on the derivative contracts arising on remeasurement dates, example financial year end, are transferred to the profit and loss account. The second measurement base is the fair value through other comprehensive income, FVOCI. This measurement base applies to derivatives that satisfy the criteria for hedge accounting and the company has made an election to apply hedge accounting. All unrealized gains or losses and losses on the derivative contract, the hedging instruments, on remeasurement at financial year end is recognized directly in other comprehensive income and accumulated in the hedging reserve or equity until the hedge item is disposed of. When the hedge item is derecognized or disposed of, all unrealized gains or losses on the counterpart derivative contract, the hedging instrument, are recycled back from the hedging reserve to the profit and loss account. This second measurement base, which is the FVOCI measurement base, eliminates what is called the accounting mismatch that would occur if the fair value through profit fair value through profit and loss measurement base was applied. The FVOCI measurement base also reduces the volatility of profits in the profit and loss account that would arise if the hedged instrument and the hedge items were accounted for in different accounting periods. We'll now go through an example of a derivative that meets the criteria for hedge accounting. A business operating and reporting in US dollars makes a sale to a customer in Europe for 100,000 euros on December 2, 2018, when the Euro-USD spot rate was 1.23. The customer is expected to settle the account in 60 days in euros on 30th of January 2009. To minimize the foreign exchange exposure, the business enters into a foreign exchange forward contract on the 2nd of December 2018, the same date the sale was made. The contract agrees that the business will sell 100,000 euros in 60 days' time, 30th of January 2009, at a Euro/USD forward rate of 1.25. So the business has a financial year end of 31st of December and has designated the derivative as a hedging instrument. The Euro-USD spot and forward rates on the following date, which is December 20 and 2009, is given here. So what you're required to do is how should the above transactions be accounted in the financial statements for the year ended 31st of December 2018 and 2019. Assume that the company has made an election to apply hedge accounting. So let's start with some preliminary observation. The transactions referred to in the question are the accounts receivable, which is the hedged item, and the FX forward contract, which is the hedging instrument. Now, accounting for the hedge item and the hedge instrument, needs to be considered at three different dates. First is the sale date, when the product is sold to the customer and the foreign exchange forward contract is entered into. The second is the balance sheet date, when the value for the accounts receivable and the forward contract liability needs to be restated. And three, the settlement date, when the customer makes payment in euros and the foreign exchange forward contract must be settled. Our first task is to calculate the effects of the foreign exchange rate movements on both the accounts receivable account, which is the hedge item, and the FX forward contract, which is the hedge instruments, on the following three dates. If we look at the accounts receivable, the three dates are the date of sale, the year-end date, and the settlement date. Now, because the accounts receivable, it has to be stated in US dollars, which is the functional currency of the business. Using the spot rate of 1.23, it gives us a balance of $123,000. At the year end, the same account balance has to be remeasured using the new rate of 1.20, and this gives us a balance of $120,000. So there is a loss of $3,000 at the year end, which is the difference between $123,000 and $120,000. Finally, at the settlement date, the spot rate is now 1.18. The company is only going to receive $118,000. And again, if we take that away from the old balance of $120,000, we get a difference of $2,000, which is a loss. So the cumulative loss on the accounts receivable account is $5,000. Let's look at the foreign exchange forward contract account. The value of this derivative will depend on movements in the forward rate. On the date of sale, the company agreed to sell 100,000 euros in 60 days time at a forward rate of 1.25. So that fixes the amount that the company is going to receive, which is $125,000. At the year-end rate, the forward rate is now 1.24. The dollar has strengthened, and you're only going to get 124,000 if you take this spot forward rate. And if we take the difference, the value of this FX forward contract account is 1,000. When we come to the settlement date, and that's the date when you settle the derivative contract and use a spot rate of 1.18, it's now the amount you're going to receive when you sell 100,000 euros is 118,000. And if you take the difference between 124,000 and 118,000, you have a gain of 6,000 on the settlement date on this derivative account. So the total gain on the FX forward contract account between the date of sale and the settlement date is $7,000. So here we see how hedging works. The loss on the hedged item has been offset by the gains in the FX contract. So summary of movements in the accounts receivable and FX forward contract accounts so far. What we have observed is that the movements in the euro and USD exchange rate have offsetting impact on the value of the account receivable balance and the forward contract at year-end date and settlement date. Under hedge accounting, remeasurement gains and losses in the hedge item and hedge instrument at financial year-end are deferred to the OCI and hedging reserve and recycled back to the profit and loss account in the accounting period when the hedge item is settled or de-recognized. So at 31st December 2018, the $3,000 loss on the accounts receivable and the 1,000 gain on the FX forward contract are transferred to the OCI and hedging reserve. The balance sheet at 31st of December 2018 will show the following balances: the account receivable balance of 120,000, the forward contract asset of 1,000, and the hedging reserve of 2,000. Alright, let's look at what happens on the settlement date, which is 30th of January 2019. Look at the balance on the accounts receivable at 31st of December 2018 brought forward, which was $120,000. In 30th of January 2019, we received cash of 118,000 based on an exchange rate between the euro and the USD of 1.18. This gives us a loss of $2,000 on the accounts receivable account. Let's look now at the movements on the derivative account. We have a gain in 2019 of 6,000, and that represents, if you like, the year-end exchange rate, which was shown at 1.24 against the spot rate on the settlement date, which is 1.18, which gives us a gain of 6,000. We also have to recycle the net loss from the hedging reserve, which is 2,000, and if we all net it all off, we will have a balance which is a net gain of $2,000, and this is transferred to the profit and loss account in 2019. Summary of hedge accounting criteria. Hedge accounting is optional. A company may elect not to adopt the specific accounting rules and instead account for the hedge item and the hedge instrument separately as unconnected transactions, i.e., all gains and losses on the hedge instrument is taken to the profit and loss account as they arise. To qualify for hedge accounting, the entity has to document the economic relationship between the hedge item and the hedging instrument. In addition, each hedge relationship will be subject to two types of tests to determine the effective and any ineffective portion of the hedge. The first is the prospective test. It requires the matching of the critical terms in the hedge item with the critical terms in the hedging instrument, i.e. the maturity dates, the currencies, interest rates, and notional amounts. The second test is the retrospective test. A key test is the dollar offset method, also known as the hedge ratio. In this test, you offset the changes in the fair value of the hedge item over the hedge period against the changes in the fair value of the hedging instrument. A hedge is effective when a gain in one financial instrument is matched by a loss in another financial instrument. There are three types of hedges: cash flow hedge, a fair value hedge, and a net investment hedge. This classification affects how these hedges are measured in the financial statements. Cash flow hedges. Cash flow hedges are derivative contracts to hedge highly probable forecast transactions, example purchases or sales, to reduce volatility in cash flows relating to the payments or receipts of cash in the future. An example is the use of foreign currency forward contracts to hedge transaction exposure arising from revenue in foreign currency, say 1 or 2 years in the future. Cash flow hedges will qualify for hedge accounting provided it meets the criteria for an effective hedge. Accounting for cash flow hedges, the measurement basis is fair value through other comprehensive income. The cash flow hedge derivative is measured at fair value in the balance sheet. Hedge accounting. Changes in the fair value of the cash flow derivative on remeasurement dates, example financial year end. If the cash flow hedge is partly effective, then only the effective portion of the gain or loss in the derivative instrument is recognized directly in other comprehensive income and the hedging reserve. The ineffective portion of the gain or loss is recognized in the profit and loss. When the hedge item is derecognized or disposed of, any unrealized gains or losses on the cash flow derivative contract is recycled from the hedging reserve to the profit and loss account. Fair value hedge. The measurement basis for this is fair value through profit and loss. A derivative is classified as a fair value hedge when it hedges the exposure to changes in the fair value of a recognized asset or liability, example an equity investment or a term loan. Any gain or loss from remeasuring the hedging instrument or derivative contract to fair value is recognized immediately in the income statement or profit and loss account in net finance cost. Any gain or loss on the hedged item attributable to the hedge risk is adjusted against the carrying amount of the hedge item and recognized in the income statement within net finance cost. So the last type of hedge is called the net investment hedges, and it's measured at fair value through other comprehensive income. Hedges of net investments in foreign operations hedge the exposure of foreign currency denominated assets to minimize the foreign exchange risk. This is primarily achieved using forward contracts denominated in the relevant foreign currencies. The accounting for net investment hedges are similar to cash flow hedges. Any gain or loss on the effective portion of the hedge is recognized in other comprehensive income and accumulated in the translation reserve in equity. Any ineffective element is recognized immediately in the group income statement. On disposal of the foreign operations, the cumulative gains or losses recognized directly in the translation reserve in equity are transferred to the group income statement.